22nd is the last day of class. We've got to give out the Sonkin Prize on that day, so we can't get the papers in on April 22nd. That was a mistake. In the first half of this class, we announced that the papers were due April 16th. That is the deadline for the Introduction to Value Investing papers, and it is the deadline for this class. Is that clear? We got the deadline for the papers wrong. Is there any questions about that? It was my mistake. I hate to get them, I hate to grade them, so of course subconsciously the date in my mind is in 2016. Not April 16th, but they will be due April 16th because I have to read them first. I have to select the finalists, and then they go to a panel of 3 distinguished investors who actually pick the winners. Okay? I guess, well, let me change that. I think Ben was right. If you don't care about getting the Sonkin Prize, you can get it in as late as the 22nd. So, to be eligible for the prize, you got to get it in by the 16th. Okay? Maybe that's a better adjustment, because they'll come in later and I'll pretend I don't have to grade them. All right, I want to say 2 things about Mason Hawkins from last time that you ought to pay attention to. The first is when he did his 5 principles. If that's Mason Hawkins, go ahead and keep it on. 2 of them were actually oriented to the technical business of searching for opportunities and valuing those opportunities. 3 of them, patience and courage and discipline, all have to do with character. And that's something I hope you'll notice about all the speakers, that in the successful practice of value investing, and I hope tonight's speaker will endorse this, that since he has a fabulous record on his own, he's free to disagree, those elements of character, that is discipline in not chasing opportunities, patience in waiting for opportunities, and courage in taking advantage of the opportunities when everybody thinks the world is ending and the opportunities are there, which are the elements of character, are probably in your investing lives going to be about 60% of where you add value. And the technical abilities that we've taught you here will add 40%. It is that mix that I think you want to pay a lot of attention to as you listen to these speakers and the emphasis that they put on. Second thing is that you will notice the evolution that he's gone through. That he started out as an asset investor and he's basically involved in the direction of a franchise investor. That is the direction clearly in which the value community has gone, because of course that's the direction in which Warren Buffett has gone. What I would remind you of is when he started, however, to talk about individual stocks, he was still, and you look at his holdings, the asset-intensive, asset-related bargains have not disappeared. So while people tend in that evolution to talk about the Buffett-oriented, the Dells of the world and so on, the Aons of the world, in practice I would not forget, because I think even though they talk about it less, they have not forgotten it, the value of just looking for asset-intensive businesses with earnings power protected by assets, with no significant growth prospects for value creation, that because they're despised are still available at very cheap prices. So even though what you heard was predominantly a talk about franchise investing, I think it would be wrong to say that if the opportunities for asset-based investing are there, that he's going to ignore them. All right. Tonight's investor, Bill Nygren, is also somebody who needs basically no introduction. He has a phenomenal record as long-term record as head of the Oakmark Select Funds. I'm not going to do his background. I assume we're going to talk through it when I interview you, because basically we're going to do this as a question and answer from me, and then you guys will leave plenty of time for your questions at the end. Okay? Bill, why don't you take the chair with you so you're not big. Okay, so obviously the first question, Bill, is how did you get involved in investment management, and then how did you evolve into a value orientation?
I thought the first question would be, did I agree with what you said about Mason?
Okay, do you agree with what I said about Mason?
I do.
Yes.
It's funny, Mike Neary is also here. Mike heads our client communication side of the business at both Harris Associates and Oakmar. And our day started with breakfast in Boston with client meetings, so it's one of the reasons that I'm sitting down now. It's been a long day already. But we were talking about how funny a business this is now. 10 years ago, people thought our fund family and me personally were geniuses. 2 years ago, they couldn't understand why any of us still had jobs. And now again, we're geniuses. If you don't have the personality to kind of let those compliments and criticisms roll off, and instead you take them to heart and you believe them, you've got no ability to survive in this business. The people will love you after you've done something well, then you can't repeat it, and they'll think you're an idiot. And you just can't take any of it seriously. You have to have the self-confidence to believe that what you're doing makes sense over the long run, and a very level personality that you don't need other people's endorsements of you to satisfy your own ego. So, how did I get interested in the investment business? I think there are various points in my life I could go back to, but I think a lot of it goes back to very young childhood, where I quickly learned I had more of an affinity for numbers than words. I love sports. I always had a more intense interest in sports than I've had talent for participating. So I've continued to be a lifelong fan rather than a participant. But the numbers sides of sports really intrigued me. Growing up in St. Paul, Minnesota, as a Minnesota Twins fan, the page of baseball statistics that was in the newspaper always fascinated me. I was always looking at the box scores. My kids, or your generation, the story of seeing box scores in an afternoon newspaper, because that was the first time you had a chance to see them in the day, was probably something that's a historical artifact. But that's the way we got information back then. And in the St. Paul newspaper, the page next to the baseball box scores happened to be the stock quotes. And I was fascinated by it because they were numbers, and I could see they moved around a lot. And when I talked to my dad about it, he told me that the numbers represented dollars. It became much more interesting to me. And it was something I had a passion for learning about. And throughout my teen years, high school years, I was reading most of the books I could get my hands on from our public library about the stock market. That wasn't as big a deal as it sounds now, because back then the section of the library was maybe this wide and 2 shelves that talked about investing, instead of today where you'd have a whole section of the library that would be about investing books, because it's become so much more of a popular subject. But my interest in investing was very strongly developed even before I got into college. I went through college at the University of Minnesota getting an accounting degree because I felt like learning accounting, if I wanted to go into investing, to go into investing and not know accounting would be like saying you wanted to work in France but you didn't want to learn French. It's the language of business, and to analyze companies and understand business valuations. I thought I needed that level of understanding of accounting. In hindsight, I still think that was a good decision. The value side for me came about, I think, also from a young age. I grew up in a middle-class family, and watching my mom behave as a consumer was very much like watching a value investor. She had a strict budget of what she could spend for food and clothing, and she would shop sales. And when I'd ask her, why didn't you buy cherries this week, it was because they weren't on sale, and if you wait another week, you can buy twice as many for the same price. And so I learned at a very young age that as a consumer, if you paid a lot of attention to prices, your money would go a lot farther. So when I started to get interested in investing, I was reading all these books on investing. The books that focused on value were the ones that resonated with me. And I've always said, as a professional investor, I think you can look back to that time when you're learning about investing and the different styles that are out there. And it's so important that you pick a style that meshes with your personality, because this is a business that messes with your head all the time. You're viewed as being least likely to be right when it's most important that you have conviction in your ideas. You have to have a lot of self-confidence. And if your personality is fighting with the investment approach that you've adopted, you've got an additional hurdle that's going to be very hard to overcome, because especially at turning points, you need to have conviction in the approach that you're using. So as I finished my undergraduate work in Minnesota, I'd done a couple of internships. One was at an accounting firm back then. It was Pete Warwick and Mitchell, eventually became KPMG. And I was able to audit some insurance companies and focus on those audits in the securities side of the business. And spent some time talking to people that were in the investment parts of those operations. I also worked in the accounting department of General Mills, a Minneapolis-based company. And there I met someone who was a good friend of a professor at the University of Wisconsin, Steve Hawk. And at the end of this program, all the interns would go out to lunch one-on-one with the various executives of General Mills. And he asked me what I wanted to do, and I said I had hoped that I could maybe get a job in their pension department where I'd be making decisions on investments. He says, that's not the way you want to go. He says, what you should do is contact this guy, Steve Hawk, at the University of Wisconsin. He runs a really interesting program, the Applied Securities program. And he said, if you're really interested in investing, General Mills isn't the place for you. You need to pursue this route. So at that point, I had a pretty good academic record. I had applications in at Stanford and Chicago, Berkeley, and so I decided it wouldn't hurt to spend a day drive down to Madison and understand what this program was about. And it was exactly what I wanted. It was a group of students working on a real portfolio. A brochure from Stanford said you got to run a pretend portfolio. It cost 3 times as much and take twice as long to get through the program as Wisconsin. So my value investing side said Wisconsin was a much better deal. It was run by a professor who was also a president of a money management firm, as opposed to a more academically oriented professor. So that summer, actually, the same day I graduated from Minnesota, I drove down to Madison and started their program the following day. After that, I went to Northwestern Mutual in Milwaukee. I worked for them for a couple of years. A couple of things I learned from that job that I think were really important is how important it is that you have a match of investment styles with the decision makers that you're working with. I was very much a value thinker at that time, and they were much more some combination of fundamental and technical, and we were like two ships passing in the night. I would find something that had a chart that pointed straight down that I thought was cheap based on assets and potential earnings. Talk to them about it, say we should be investing in it, and they'd say none of the brokerage firms are recommending it. The technical chart looks terrible. 6 months later, if the stock was up 30, 40% from them, they'd start to be interested because the technicals looked better. And I would just get frustrated because by that point the stock wasn't very interesting to me. So I learned it didn't really matter what kind of quality of work I was producing. If it wasn't what the portfolio managers wanted, it wasn't of any use to them. And the other thing I learned was the investment industry has a different kind of pay scale than an insurance company does. And it really wasn't in their interest to try and be competitive with other investment opportunities. They were an insurance company first that had to have an investment division that didn't screw things up too much, so that they couldn't afford the risk that bad investments affected their insurance side. But excelling at investments didn't do enough for them to make it worth making that important goal. So not only did pay scales not match what was going on in the private investment side, but when they found people they thought were promising in the investment side, they would try to pull them out and put them into the rest of the insurance organization. And I've been there about a year. Some of the people outside of the investment department thought I was a reasonably promising young executive. And I got to have a meeting with the CFO of the company, who told me that he was really excited to offer me this chance to be in their management training program. It would mean I would have to leave the common stock department. And with the political savvy you might expect of a middle-class kid from Minnesota, I said, I don't think you understand this. I'm a common stock person who happens to be right now working with an insurance company. I'm not an insurance executive who happens to be in the common stock department. So about 3 months later, I was leaving Northwestern Michigan and had an opportunity to join Harris Associates. There's another alumni from the Wisconsin program who had called Professor Hawk and said, need somebody who's a real value-oriented person. That's everything we do at Harris Associates. We don't want to train somebody to be a value thinker. We need that to be ingrained already. Has anybody come out of the program recently that it would be worth talking to? And I went down, interviewed with Clyde McGregor and some of the other management of Harris Associates. I figured it was a job I'd be at for at least 3 years, and that was 27 years ago. I joined there as a generalist analyst, eventually became director of their research department. In '96, was the original portfolio manager on the Oakmark Select Fund. Took over management of the Oakmark Fund in 2000, added Oakmark Global Select in 2007, and couldn't be happier with the company I work for, the people I work with. It had the match of investment style that I felt I needed. It was their main business. And one of the most important lessons I've learned at Harris Associates is how important it is to be surrounded by smart people that you can learn from. Because anybody who's been in this business for any length of time has to evolve. They have to become a better investor. The field gets more competitive every year. And it's only by being around people that are as smarter than you are that you're going to elevate your own game to be able to keep improving. So that brings us up.
Right, okay. So when you started at Harris Associates, what kind of investment process did you go through and what was in place? I mean, how did you find opportunities? How did you evaluate opportunities? What were you looking for? So.
Harris was very much a value investor, and much like what Bruce said that Mason commented on last week, we were more in an asset mode at that time. The specific product I was working on, I guess today you'd call it a hedge fund. We just thought of it as a private partnership that had an incentive fee structure. It was very small, and we were generally looking at small cap stocks. Our universe, investable universe, was small cap stocks that were selling below book value. And the approach was, as my mentor and one of Harris's founding partners said, when you invest in a company, you're buying two things. You're buying management, you're buying a balance sheet, and they both need to be right. And so from a quantitative point of view, we tried to make sure we were investing at a discount to the asset value of the company. From a qualitative point of view, we tried to make sure the management team we were investing with shared our goal as outside investors, which was maximizing long-term per share value. So the process was we would look for statistically cheap stocks. Some of that would come from screens, some of it would come from brokerage reports. Generally, they were the reports that brokers were suggesting sell rather than buy. But if you ignored their opinion and focused on their facts, they were useful reports. And we developed what I would call an inbox of ideas that looked statistically cheap. And we try to sort through those to find the companies where management was aligned with the outside shareholders, and where we didn't think the company was structurally disadvantaged. I mean, obviously, if you're looking at the absolute cheapest stocks, doing screens for discounts to book value, lots of the companies you're looking at are companies that are in disadvantaged positions, either industries that are dying, or companies that are at cost disadvantages versus competitors that are growing market share. And our job was to try and sort through those, avoid those companies, and find the companies that actually had what I would maybe generously call average futures ahead of them at very cheap prices. And we would then go and interview those managers, and if we could get comfortable that the managements were working with us, that was a stock that we would generally purchase for the portfolio. We didn't really use any sophisticated portfolio analytics. It was more a collection of very cheap stocks rather than trying to think about an optimized portfolio in any sense of that word. It was also our investors, we generally had a pretty small slice of their assets, so we weren't too worried about industry diversification. It didn't matter to us if there were S&P sectors that we had no exposure in or others that we were triple or quadruple weighted. It was just a collection of cheap stocks where we thought managements were smart and had our interests shared as their interests. I think one of the significant changes I was able to effect there in the 3 or 4 years that I spent working primarily on that product was getting us to at least acknowledge that GAAP accounting had some shortcomings, and there were some very valuable assets that didn't show up on the balance sheet that we ought to consider as part of book value in our investable universe. Brand name being one of the easiest examples of that. As you know, advertising spending, which helps develop a brand, all goes through the income statement, none of it gets onto the balance sheet. So for most consumer products companies, their most important asset is on the balance sheet at zero. We tried to make estimates of what those brands might be worth and explicitly add that to book value so that we could consider, for example, at that point in time, there are food companies that were selling at 5 or 6 times earnings, a fraction of sales. Most people who looked at brand values thought that brand value was worth at least 1 time sales. We bent our rules just a little bit to say, let's put an asset on the balance sheet called brand value at 1 time sales. And if these companies are cheap relative to that book value, we can then add those to our portfolio. We later expanded that to include other assets, and then eventually moved to a primary methodology that was more EBITA focused, enterprise value to EBITA, and again, much like Mason's comments, could probably hit the play button on his presentation last week. It would apply to a lot of what we do. When consultants ask us who is most like us in the value investing community, we say Southeastern Asset Management. But our EBITA model then became trying to estimate what the full value of the company was on an unlevered basis, and then how large a discount to that were we getting today if you summed up the debt and market value of the equity. And it kind of moved then from a discount to book value to saying if we can buy at 60% or less of business value, which was generally earnings based, that was enough of a discount to give us the same type of cushion we used to get on book value. And asset value for us became a backup model. We like to use different valuation methodologies and be able to tie them together. So a very typical question in our process today is how do you get from a book value of X to a business value of 4X? What are the assets that aren't on the balance sheet that we're thinking have value in this company? And we tend to have greater comfort in the ideas that we can support with more than one valuation methodology.
When you talk to management to determine what's a good management or not, how do you conduct that process and what do you look for?
What we're looking for is the easiest part of that to answer. We're looking for clues that management's goals are the same as our goals. I think when I started in the business, again, almost 30 years ago, there were a lot of managements that didn't even believe maximizing the total value of their company was their primary goal. They were focused on the community, stakeholders was a concept that was important, and there wasn't the tie that the reason to be supportive of your community or good to your employees was because that was part of maximizing the business value. So I think we saw a shift 15, 20 years ago where at least management's got that idea down, that their primary job is to maximize value. I think today the challenge is to make sure they've taken the next step, which to us is maximizing per share value. And that distinction is tremendously important because if you think what's in the CEO's interest as an employee of the company, it's generally to get bigger. That's what makes their job more important. It makes their job more prestigious. And there are lots of ways you can make a company bigger that don't end up increasing the per share value of the company. You can grow the value 50% through an acquisition, but if you have to issue 60% in shares, you decrease per share business value. Unfortunately, there's still a lot of managements that either don't seem to get that or they behave in a way that would say they don't take that responsibility seriously. None of them will come into your office and admit that. If you ask, do you try to maximize per share business value over an intermediate to long-term time horizon? Every CEO in the country will answer that yes. So you have to kind of get there indirectly by asking them other questions about what's important to them, how do they spend their time, 5 to 10 years down the road, what's the legacy they'd like to leave when they're no longer CEO of the company, and kind of piece together whether or not their answers seem more likely to be consistent with someone who wants to maximize per share value or more likely consistent with someone who's just trying to make the company and their own job bigger. I think one of the most important things in a management interview is to get them out of their prepared presentation, especially when you're in the mid and large cap universe, which is basically what our investments are limited to. When you're dealing with C-suite executives, they are very polished. They are great speakers. They know how to spin a story really well. They have been prepped on how to go through their flip chart book. They've been prepped on what questions shareholders are likely to ask. And you will always walk out of a meeting. If you let them go down their presentation, you'll always walk out of the meeting saying, wow, that was an impressive management. I think my biggest role in management presentations today is to get them out of their prepared presentation, however I can do that. This story's getting a little bit old, but there was a large chemical company that came into our offices one day. Stock looked statistically cheap. We thought it might be something we could invest in. And on our side of the table, there were like 4 of us that were dressed casually. On their side of the table, I think he must have brought in 7 or 8 people with him who were all sitting down there to support him. For what it's worth, I tend to prefer meetings with CEOs who will come alone and they don't bring a big entourage with them. But he started into his presentation and he wanted to spend this whole hour going through his flip charts. And so I had to start asking obnoxious questions to try and get him off of his game and into a discussion with us. And at this point, this company had like 3 divisions. They had a commodity division, a specialty division, and I think the other business was healthcare. And they were selling off their commodity businesses because obviously those businesses weren't as good as the specialty businesses. So I'm like, excuse me, does that mean the people you're selling these to are so stupid they can't figure out that those aren't good businesses? And he kind of gets all upset that he's been interrupted and tries to answer my question and didn't really answer it. I'm like, well, are you getting the same multiples on that business that you're selling as where your stock is? Again, it was a question he didn't want to answer. And he kind of moved on then to how he wanted to get out of commodities and then buy another big business because what he really wanted was to have a solid 3-legged stool. And I'm like, excuse me, my grandma used to have a 3-legged stool, and it was the least solid piece of furniture in the house. And the guy, at this point, you can see him looking like, who is this guy down here? Why is he being so obnoxious? But where that took us was he eventually got so annoyed by it that we were able to enter into a conversation instead of letting him page through his flip charts. And I could be the bad guy who got him out of the presentation, and then the good guy could take over and actually ask the questions that we wanted to have answered in that presentation. And at the end of the meeting, we were quite highly confident this was somebody who was much more interested in the prestige of his position, much more interested in trying to grow the value of being CEO than he was at all concerned about where the company's stock sold. And it was a pretty easy decision for us then to say, this is something that we don't want to be invested in. Before a management meeting, you can look at where their incentives are. Do they have how much stock do they own? Do they have options? What kind of performance pay incentives do they have? Do they track sales? Do they track earnings? Or do they tie to things that we care more about, like return on invested capital, that we think are more important for driving equity prices? That part you don't need to sit down with the CEO about. You don't need to waste their time with that. With the CEO, it's more about what really matters to them, what makes them tick. Is it the same stuff that we care about? Because if you're a long-term investor, you think, when we buy something, we think we're probably going to be a 5-year holder of it unless we get lucky and the price appreciates faster than that. In that length of time, management is going to have chances to do transforming acquisitions. They might have opportunities to sell divisions. They might even be able to sell their whole company. And it's really important to us that as they face those decisions, their primary metric that they will look at is what is this going to do to long-term per-share business value of this company? And you can get clues about that by what's important to them when they talk to you. I like managements that come in alone. I like managements that will come in and say, what do you want to talk about, rather than somebody who comes in with a prepared presentation. I think those tend to be the companies that you have a higher probability that they aren't trying to hide something from you. When a company goes through it, you've got an hour with them, they go through a whole presentation, they take 59 minutes and say, gee, I'm really sorry, but I didn't leave time for questions. That ought to be raising red flags for you.
Okay, so why don't we start talking then about recent experiences. In this process that you actually alluded to, where for 2 years you were the stupidest person in the world, and now you're a genius again. Going through those 2 years, are there any lessons you've taken away from your experience in the process starting, I guess, in 2007?
I think one of the most important lessons is sticking to your discipline. And I think so many times in this business, you see companies get in trouble because they try to provide what they think their clients want, as opposed to realizing that their clients hired them because their clients don't know how to do this themselves. And you need to be almost parental with them sometimes to say, I know you think this is what you want, but that's not what's going to help you meet your long-term goals. At Harris Associates, we had wealthy individual clients who were so scared back a year ago, 15 months ago, that they may have been clients for 15, 20 years, and they're calling us saying, I want you to dramatically reduce our equity exposure. It became an important challenge for us to try to talk as many of them out of that as we can, basically to the point of saying, if this isn't keeping you up at night or making you physically ill, please trust us and let us do our job that you hired us to do. Same thing on the mutual fund side. We don't have as much one-on-one conversation with those people, but the quarterly communication to our clients had to show the importance of consistent application of the investment philosophy, had to show the importance of investors rebalancing their target allocations rather than aggravating the problems that they were in by selling the asset class that had underperformed the most. I think one of the other things is, like, even in stock selection, we saw some of our peers who basically abandoned their discipline. Bottom-up value, long-term investors who, throughout long, successful careers, felt that they had no special skill at predicting the economy. At a time when stocks looked more attractive on their models than they looked in say, a decade, since the decade ago starting point was so high, multiple decades. They abandoned their discipline and let a macro overlay talk them out of being as aggressive in equities as they should. And again, I can't stress enough how almost all of the value of a long-term value approach is added at turning points. And if you look at our record last year, by sticking to our knitting and owning the kinds of stocks that looked most attractive on our valuation models, last year we were able to do something a couple thousand basis points better than the S&P. That could easily be followed by 5 or 6 years where we don't do any better at all. But it's those years that are big turning point years that if you don't screw those up, those are going to make a multiple year good track record. And I think most of us on the long-term value side create our record by you have a few of those exceptional years, and your bad years aren't that horrible relative to the rest of the market. And if you're questioning your discipline at the time when those opportunities are the greatest, if you miss a chance to create a 5-year record in 1 year, that kind of chance won't come around again for 5 years or so. And the people you hear now who are saying, oh, this is becoming a stock picker's market, like, where were you people a year ago when valuations really were so dispersed that a stock picker had tremendous opportunity to add value? I think they're late to the game right now, thinking that this is an unusual opportunity to add value through their stock selection. This is a business that has extreme cycles. There's no business that's more fun than this when things are going well. And I think there are very few businesses that are less fun when things aren't going well. Warren Buffett saying something to the effect of he skipped to work every day of his life. I've always sort of felt that way. Walking into the office in the morning or from the train station, you see these people who are kind of plodding with their heads down, walking to their jobs, and then I could say I'm so happy I'm not one of them. And a year ago, if you looked at me walking into work, I was walking with my head down, and man, I have to do this again, because it was like you're getting beat up every single day.
On the other hand, though, everything's really cheap.
Oh yeah, well,
so there is a compensation.
But everything's really cheap, and that's wonderful. And then you turn on your computer and you see that investors pulled $5 million away from you. So it's like, okay, which of these incredibly cheap things am I going to sell today? Which one is slightly less cheap than the others, so that I'm not hurting my remaining shareholders by selling out the people who lost confidence either in us or in equities. So, like the comment I made at the introduction, you you can't let other people's impressions of you, either good or bad, form your own impression of yourself, because that will make you least confident at the times you need to be most confident, and most confident at the times you need to realize that maybe the market isn't giving you the opportunities that it's worth making the really big bets.
Okay, I'm going to go to, I have some questions that are really good ones, actually, for the students. Mike Gajewski, are you good?
Yeah.
Go ahead, Mike.
Yeah, well, that's probably more articulate if I finish your read for when
All right. I didn't want to do this because I wanted to pretend, and this is semi-spontaneous. Okay. You have 8 positions in TV distribution through Comcast and DirecTV, 11.4% collectively of select funds. How do you see broader, faster broadband access impacting the business models of cable and satellite TV companies?
Hugely beneficial. I think faster internet and more ubiquitous internet is going to destroy print media at an ever-increasing pace. I think how our video gets delivered is going to be over-the-air broadcast, it's going to be cable, it's going to be satellite, and it's going to be internet. I don't think the internet is going to destroy the business models of satellite television. Satellite is such an efficient way to deliver. It's such an efficient way to deliver video. It doesn't make sense to me that effectively live programs would hog up that much bandwidth. A little less of a problem for Comcast than it is for DirecTV, because I think it's likely that for some time the cable company is going to have the best wire coming into your house, and it's likely that we'll be able to send more stuff over wires than we can wirelessly, and that it will stay more dependable. I also think one of the more interesting things about Comcast is the acquisition that's pending on NBC Universal. That stock has underperformed for a very long period, pretty much ever since they announced they wanted to try and buy Disney, because people had feared that they would do a big dumb stupid deal. And when they announced the NBC Universal deal, that they were paying $30 billion for NBC Universal, I thought, this is finally if they're doing a stupid deal. I was wrong. Because I thought the Roberts family and management of Comcast was always pretty focused on growing business value, shareholder-oriented. And then started to look at the terms of the deal, found out that GE was basically getting paid with what was effectively their own money, and Comcast was only paying about $6 billion to do this $30 billion deal. So I think there's a value add at Comcast from the NBC Universal deal. On a $16 stock that's probably $3 a share or more, that gives me a little bit of a cushion if I'm wrong on how much better broadband access takes away from cable. I also think in the more rural areas, it's going to be a long time until we have really, really good broadband. And the satellite companies are the best way to deliver video there for quite a while. And those companies aren't all that expensive. They're relatively low capped EBITDA multiple. I think the satellite companies also have an incremental strategic value to someone like an AT&T or Verizon. So in addition to what I think it's worth as a standalone company, which is enough to justify the investment in DirecTV, I think there's a strategic value that could make it a significantly better return for us than as a standalone. But really good broadband, widely accessible to everybody, I think is the big risk on both of those stocks. I just think it's longer in coming, slower potential decline rate than our current models, than some of the bears on the stock might be looking at. And I also think you've got some offset in both companies.
Actually, Mike, I'm going to give you a chance if you want to ask a follow-up. But Matt, you also want to jump in here because you're Matt Martinic?
My question was pretty similar, but the other...
Right, but you have a...
Yeah, the second part of that was just how do the telcos, is that what you're getting at? How do the telco industry entering the pay TV market?
Yeah, what's your view of telco competition?
Right.
I think that's right.
Yeah.
One of the reasons we haven't owned many of the telco companies over time is it's been harder to get comfortable with those managements or focused on growing per share business value. There have been a number of different times in my career that there has been concern that telco overbuilds were going to put cable companies out of business. And the results of all the previous ones have been that the telco companies spent enormous amounts of money with very little return and eventually pulled back from their build-out plans. I think that's the likely case again, and I think that's one of the reasons that a company like DirecTV is a pretty interesting takeover candidate, because I think it is a much lower cost way for a company like Verizon or AT&T to deliver the audio-video bundle to the home than doing their complete fiber build-out to all their homes, which I don't think you can justify on a return on investment.
But what do you think that's going to do to cable companies? I
don't think the build-outs will end up being in some of the markets where they've been competing. The phone companies are having a harder time getting subscribers than some of the pessimists had originally forecast. And I think we've already seen some indications from Verizon that they're slowing down their planned expansion of their, is it called BIOS or something?
BIOS. Matt, you happy?
Yes.
Okay. All right. Jamie Williams.
Yeah, right here. I think I can rehearse what, but so Medtronic, the second largest holding in the Oakmont Fund last quarter. The spine business looks like it's about a quarter of the revenues, and I know they dominate that market. There's been some discussion in the world that if comparative effectiveness becomes real, the latest and greatest spine treatments might not fare so well in terms of reimbursement. So what do you think about that risk?
I'm not going to be real good about talking about the spine business specifically, but one of the reasons we own Medtronic rather than some of the other device companies is we think they're much farther along the curve on economic analysis rather than just efficacy analysis of their products. They were one of the first last week to announce a study. I don't remember which product this was. I think it was for one of the cardiovascular ones rather than the spine products. But specifically doing trials to show economic value of the product as opposed to just does it work or not. I think that's going to be an important move across all of healthcare, and where we have taken positions in healthcare, we have tried to orient toward those companies that we think have paid more attention to the issue of what's the economic value of their product rather than what's just the medical value of it. Most of our other holdings, other than Medtronic, are basically in pharmaceuticals. I think across the board in the pharmaceutical business, economic efficacy is pretty easy to demonstrate because of avoided costs of other forms of treatment. So I think no matter who ends up controlling the healthcare spending, somebody has to get rational economics more involved in healthcare spending if we have any hope of bending the cost curve. Whether that's the government, the insurance company, the individual with healthcare spending accounts. Right now, one of the biggest problems we've got in healthcare spending is nobody is really having to answer the question of is it worth the dollars is this treatment worth the dollars that we're spending on it? And I think we'll see more of that across the board.
What about the structure of competition in these industries? Are you worried about competition among the pharmaceuticals once major drugs go off patent?
10 years ago, when a drug went off patent, your analytic model might be, the last year on patent, we'll call that X cash flow. The next year might be 0.75, the next year 0.6. 6, you have this nice slow decay curve. Now you're at X 1 year, 0 at X. So I think competition, once something's off patent, that's across the board and already applied in prices. The next level of competition is, can you have a competing drug that uses price as their competition mechanism to take market share from a market leader? Haven't seen a lot of that. And once someone has established a leading market share, it tends to be pretty hard to take away from them until the patent expires. So in the pharma side, we're not really worried about that. On the device side, we're hearing from more and more of the hospital purchasing managers that we talk to that they are trading off volume for price, and that it tends to benefit the market share leaders. Another reason we like Medtronic, that they will go to a Medtronic and say, if you can cut price 7%, we can give you 15% more volume. And they can't grow the number 3 or 4 player in the market enough to matter to them, but they've got a much better chance of getting the leader to cut prices, give them more volume, and then tell the number 2, 3, and 4 players they're going to have to cut prices in line with what the leader did. So I think in devices, big market share is going to be a more competitive tool than it's been in the past. And in healthcare, we'll see a continuation of once something's off patent, it's done. An interesting sidebar of that is what happens in biologics. A company like Amgen is facing some patent expirations pretty soon. That stuff seems to be priced on the basis of not seeing the bioequivalents compete in the same way that they do in the pharma business. One of the reasons we don't own Amgen is we're not comfortable with that they can succeed at getting a slow decline curve in those products. And I think there's more risk of another rapid fall off.
Okay, Giuseppe, Paulino.
So in our value investing class, we've learned that value companies can be found mostly among obscure and small stocks. And looking at your portfolio, I see your main big, well-known caps. I wonder if you can comment on this.
And those well-known caps he's referring to are Walmart, Apple, Best Buy, McDonald's, etc.
That list you just read off, I don't think many people are aware of those numbers. I think there's no question the smaller you go on the cap scale, the wider the spread of where a stock sells relative to its intrinsic value. But that doesn't mean that in large cap companies it collapses to the point that there isn't an opportunity. Partly there's a business decision there. You can run a $50 million fund and invest in under $100 million companies, and you can't get much bigger than that, or you're running a liquid portfolio. But you can have a lot of fun. You can be the only analyst who covers those companies, and you can find lots of undervaluation. But if you succeed at that, it's not a business model that you can really grow and develop a business from. It'd be a great job, but I don't think it's a repeatable business. In the large cap companies, I think the biggest area of inefficiency is time horizon. Typical investor today might be willing to wait for the rest of this year, or at least the rest of this quarter. But you start talking about a 2 or 3 year time horizon, and they're uncomfortable thinking out that far. We try to think in 5 year time horizons. It allows us to focus on things that are very different than what most investors are focused on. FedEx reported their traffic this morning. It was slightly disappointing, I guess, relative to numbers. That stock can move crazy amounts on how package volume changed last month relative to what was expected. When we think about why we own FedEx, it has nothing to do with what we think next month, next quarter, next year's volume is going to be. Think about 5 years. Think about what are the tailwinds or the headwinds the industry faces. What are market share shifts that are likely based on who has a competitive advantage and who's disadvantaged? Does the network effect that FedEx is does that create enough of a barrier that it's almost impossible for somebody else to come in and compete with them? Those are things that very few investors today are focused on when they're deciding whether or not they want to open at X. And I think by thinking about a 5-year time horizon, we're looking at something that's different. Another thing we look at that I think is different than most people look at, I think to a lot of analysts, sales growth is a pretty good proxy for value growth. There isn't a careful look down the rest of the income statement, and even fewer people take that next step of looking at what kind of cash needs does the company have to create this growth, where does it generate free cash? By translating growth into per share business value growth, again, we're focused on a different metric than most of the other people are looking at. And I think that focus can create an opportunity to, even though every one of the companies that Bruce just rattled off is something you can probably find 30 first call reports on, we will tend to have a slightly different view of why it's an attractive company than anything you're reading about those companies, because that focus is much more on a very short-term time horizon. You look at something like Apple. It was about this time last year when I was speaking to this class that we were buying Apple. It wasn't that people didn't realize Apple was a great design company with really innovative products. You had people who were tremendously worried that with the CEO unhealthy, that the value of the company might fall with him not being there. And I think a profound misunderstanding of why consumers pay a premium for Apple. The investment community was looking at it like it was a device company. Electronic devices tend to get copied relatively quickly, and in tough times, maybe consumers will trade down and save 10 or 15%. We were able to buy Apple at $80 a share when it had $30 of excess cash on its balance sheet, about $6 in reported income, and because of the way the accounting worked on the iPhone, they were having to amortize iPhone sales and profits over a 2-year period because they were offering free software upgrades over that time period. We made an adjustment to their earnings to reflect cash earnings. We were buying one of the best consumer product companies, both manufacturer and retailer in the world, at something like 8 times cash earnings, adjusted for the excess cash on the balance sheet. It's just a different way of thinking about the company. It wasn't that nobody else had looked at Apple, that a $100 billion plus business value company, and there was an opportunity for a long-term value investor to think differently. I think that's an example of a company right now where there's tremendous debate. It's, for a lot of short sellers, it's one of their favorite works, and for those of us who own it, it's still a company we think is tremendously undervalued. And I think it comes down to, do you think the iPhone is changing the phone business in the same sort of way that the iPod changed the MP3 business? When the iPod came out, we thought, like most other people did, that it was only a matter of time until knockoffs came and who'd pay $200 for an iPod when they could pay $40 for a no-name MP3 player that did the same thing. Had no concept of how iTunes tied people in through software to a product that functioned very differently than anything that was a potential competitor. I think the iPhone, the App Store, has a very similar story to it that makes it unlikely to follow the growth and decay pattern that, for example, the Motorola Razr followed a decade ago. I think they have won the battle, and that Apple is going to have a growing share of the smartphone market for a long time. I don't think this is a flip a coin to figure out whether Nokia, Apple, Ericsson, whoever will have the BlackBerry, the leader 3 years from now. So again, even in a company as large as Apple, you can have an important difference of opinion in why customers buy the product, what the likely longevity of a product, the likely cash flow stream from that product can be from the average person who's investing in the company.
Okay, Emily Zhang.
The question is about the last quarter's purchase, the oil sand company. And you mentioned that in the letter to shareholders, saying that the premium asset was not backing the market price. So I was wondering, what's your method to find out the real value of the premium asset for this oil sand kind of company?
Okay, I'll do the written part because it's how do you value oil sand assets, and what are the assumptions of the oil price and production costs that underlie those values? Is that okay?
We had owned Encana, which is one of the largest companies in Canada, because we thought it was very cheap on the assets. We thought it had a management team that, unlike most managements in the oil and gas business, were focused on growing per share value. They would buy back stock when it made sense. They'd hedge when it made sense. They'd sell off assets that they thought other companies were paying too much for. In that business, you're generally looking at management teams that are focused more on top-line growth than they are per share value growth. One of the things that Encana management had identified that we agreed with was that the two sets of assets they owned being together wasn't really maximizing the attractiveness of the company to the investment community. They own a lot of natural gas assets that didn't have unusually long expected lives, but had very good cash flow now. And then they had oil sands assets that tended to attract a much, much longer term investor and tended to be something that investors who believed oil prices were likely to grow significantly valued at a very different multiple than what they would value average length natural gas assets. So they split the company in two, and then we became owners of both Encana and Cenovus. Our expectation was that investors would look at Cenovus and say they've got a lower cost position, they've got a more established management team than the other oil sands companies, and they would price it at a premium to those companies. And that we expected we'd be buying more Encana than we'd be selling off our Cenovus. That's not what happened at all. Cenovus came, like many spin-offs do, priced at a discount to the comparables. But unlike many spin-offs, they already had the infrastructure in place that we felt was deserving of them being classified as a superior company. The business model for their oil sands is in ballpark terms, they make almost nothing on them if oil prices are below $50 a barrel. And once you get above that level, their costs change relatively little. And increases in oil prices above $50 pretty much flow down to the pre-tax profit line. The way we tend to look at commodity companies is to say we're not very good at guessing what the price should be. But there are a lot of people that are placing bets in the marketplace all the time about long-term prices of those commodities. Through the futures market, I think you can go out 7 years on oil prices. And do that today, the 7-year future in oil is at something like $90 a barrel. We're a little hesitant to value these assets as if oil prices are really $90 7 years out, because in talking to both industrial companies that are users of oil and the producers of oil, they tend to think a market clearing price is going to be below that. I would say ballpark more like $60 or $70 a barrel. That's part of what kept us out of a lot of oil and gas companies when the market price was up at 150. It's what got us in when it was at 30. And when we think about a long-term value, we're saying best guess oil is between $60 and $70 a barrel. We don't think their costs change a lot relative to where they are today. And we go through a cash flow model of what the company would make at that level and value the reserves at that level. But then we also look at scenario analysis and say the chance, say 70 is the midpoint, and we think maybe there's a 50% chance it's there, and there's a 15% chance it's at 50 or 90, and there's a whatever's left 10% chance at 40 or 110, and then you start trying to value, incorporating a few different scenarios. What is this worth? And you see that the optionality in the oil sands is very positive in favor of the equity shareholder. If you say it's a normal distribution, once you get below 50, they're worthless, so it doesn't get worth any less than that. And as on the other end of the tail, you continue to benefit from the price increases. So as you do expected values, the wider your range of outcomes, the higher the value is for the equity holder. So we value it, and it looks cheap to us on our best guess of where oil prices are. But we think there's a very valuable option in the fact that we can't be certain about where oil prices are, and there's just as much chance that they're higher as there is that it's lower, and that would add value.
Okay, Zhao Ting Zhao.
For your select fund, your holding period is actually very long, like 2 to 3 years, which means you don't have a lot of opportunity to make sale decisions. But when you do sell, like can you make an example for both you sell to take profit and you sell to stop loss?
Yeah, I think you hear investors say a lot of the time that buying is easy and selling is the hardest thing to do. I think the reason most people think that is because they don't have a disciplined approach to buying. And if you don't know why you own something, the decision of when you should sell it becomes very, very difficult. And that becomes, maybe the reason you own it is because it's been going up. And then you have to decide how far does it have to fall before it's not going up anymore. But if you don't know why you own something, selling is really hard. But if you've got a disciplined buy approach, the sell decision, I think, is a very natural fallout of your buy decision. We buy a stock because we think it's selling at a big discount to underlying value. We think that value is going to grow with time, and we think management has the same interest that we do in growing per share value. Our favorite reason to sell a stock is because we were dead right on it, and 2 years later, if our value estimate was 100 and we bought it at 60, 2 years later our value estimate is 120, stock's going up to 110. We say we can now do something significantly better with this money. And we sell, we take our profits, and we start the whole process over again. It would be wonderful if that happened all the time. Obviously it doesn't. So the other reason we sell is because our reasons for buying are no longer valid. We've changed the way we think about the business value, and the discount isn't there. We've changed it in our belief that the value is going to grow over time. Or we've changed in our belief that the management isn't really trying to grow the value, the per share value, and we can't be confident with them being the fiduciaries of our assets. When we don't think management is behaving the way they should, generally we'll sell the stock and walk away. When it comes to censoring TV programs, I'm more in the camp that says if you don't like what's on TV, turn the channel, then start sending letters to the FCC. And that's the way we think about our job. If you don't like what the management's doing, walk away, make their cost of capital higher. But generally, you can waste an awful lot of time trying to fight a bad management team and destroy a lot of value while we're fighting. But every once in a while, we'll be so confident in our estimate of the business value, so confident that that's much more attractive than anything else that we can put the capital into, that we will fight management. We can't convince the CEO of the company to change what he's doing. We'll privately talk to the board. If we can't convince the board, we'll publicly argue for change. And in the select fund's history of 14 years, probably 80 different holdings or something like that over that period. I think we've had 4 examples where we had to go so far as to be public about our dissatisfaction with management and be an agent for change. there are probably 15 examples of where we've sold stocks because we didn't like the way management was acting, or we didn't like, we weren't as comfortable with the business that we were writing our business values.
Can you give an example of the 15 and give an example of what happened with the 4?
Sure. An easy example of the 15 was EDS. EDS was a company that did consulting, basically outsourcing of large corporate MIS departments. And what we got wrong on that company was how much of their profitability came from the bells and whistles that got added onto a contract after they were on site, as opposed to how much came from the basic contract. So what happens is, in good times, they come in, managements are pretty receptive to the idea that incremental spending will have good returns for them, and EDS's profit margins might have been something like 50% on bells and whistles and low single digit on the base contract. So during good times, we were massively overestimating trend cash flow that this company could create because they're doing lots of the bells and whistle business. When times got a little tough and we went through a recession, their profitability fell dramatically, and we had to assess what went wrong. Was this the market wasn't reacting right? EDS stock went down, the profits went down. We've gone way off course relative to what our analysts had projected could happen. And we had to revisit our look at the business model, and we concluded we'd made some pretty important mistakes, that the base business was not nearly as profitable as we thought, and the bells and whistle business was extremely cyclical, and we were valuing it at a much too high a multiple. When we made the adjustments for that, the stock wasn't expensive, but it wasn't as cheap as other alternatives that were available to us, and we had to suck it up and sell it at a pretty significant loss. Examples of businesses where we got involved with management teams and argued for change. Knight Ridder, newspaper company, we thought the best use of their cash flow was to shrink the cap of the company. They thought the best use was to pay double-digit EBITDA multiples for adjacent properties to theirs at a time when their own stock was selling at about 7 times EBITDA. We couldn't talk Tony Ritter into changing that approach. We filed the 13B. We sent a letter to the directors. The directors didn't want to talk to us. We filed the 13B, attached the letter that we'd sent to directors, basically saying we didn't think they were trying to maximize the value of the company. We then got invited out to speak to the board of directors along with a number of other value managers who weren't happy with how the company was being managed. And the result was that in a fairly short time, they hired Goldman Sachs and sold the company to McClatchy. For us, in hindsight, it was an extremely good exit point in the company. I think in hindsight, we were overvaluing the whole newspaper model, not realizing how fast the classified was going to decline and how much of their profitability came from the classified business. But the outcome was good. We forced a sale of the company. We got a nice premium. We were able to get out of our position at a significantly better price than if we'd sold it. Probably the most successful example, and this one goes back quite a while, 15 years ago maybe, it was done in Bradstreet, where we owned about 15% of the company, and this company that had a very nice track record in the basic business information system suddenly went off course, and we were struggling to understand what had went wrong. And in interviews with the CEO, we became annoyed very quickly that it seemed like most of the problems were self-inflicted, and the CEO didn't really share the urgency that we had in thinking the problem ought to be fixed. And I remember sitting at their offices, sitting across the table from the CEO, him saying something to the effect of, I've been in this company since I was X years old. You guys have only been shareholders for X years, and I'm offended that you think you should have as much influence in the company. And I remember looking the guy in the face and saying, we own 15% of this stock, you own less than 1%. We're hiring you, and we don't think you should have this job anymore. That ended the meeting relatively quickly. We made no progress whatsoever with the board, so again, in that case, we had to go public, urging the company to sell to another information provider. The CEO resigned. The new CEO, interim CEO, allowed us to act almost like as an advisor to the board to talk about where we saw business value decline. They came back to us and said that they thought they could grow value more by separating Dun & Bradstreet from Moody's and hiring a new CEO for Dun & Bradstreet. And it turned out in hindsight that was much more value added than the approach that we thought would have been better at selling. But we never would have gotten to that approach, and we not succeeded in rejecting the old CEO.
All right, Marcel Benjamin.
Yes. You recently added a position in Wells Fargo based on your own filing. What changes have you made over the past 2 years to your framework for analyzing banks, and what gave you the conviction to buy Wells at this time?
Well, I think Wells versus the other banks, it's always had the reputation of being exceptionally well managed, and I think how they conducted themselves through the crisis is an example of that. You look at a lot of companies, and they didn't do much to grow their top line value, yet they were forced to issue a lot of their shares, so per share value suffered. Wells made an acquisition of Wachovia, which at the time I think a lot of people questioned. But if you look at pre-tax, pre-provision income, as we measure it, we think they doubled the potential profitability of the company and only had to issue 60% more shares to do it. So on a per share value basis, between that acquisition and the cash flow they generated by staying profitable during the crisis, we think they added about 25% to per share value at a time where their stock fell dramatically. So that's one of those companies that you could easily have had on a list for a long time of, this is a company that if it gets to the right price, we'd like to own it because it's so well managed, such a good franchise. But because of reputation, it has rarely gotten down to a level that we could buy it. The crisis provided that opportunity. The broader question of how our framework changed, I think something we've done really well on industrial companies, industrial consumer retailing companies. As I mentioned earlier, we had migrated to a model that valued them on cap to EBITDA, but we didn't look like at a PE ratio or just a free cash flow to the equity ratio. We looked at the whole enterprise on a pre-debt level and demanded a really significant discount pre-debt. It did a good job of leveling the playing field for companies that had excess cash, like Apple that we talked about, or other companies that had a lot of debt. That if you demanded the same degree of discount to total business value, you didn't have the bias toward a debt-heavy company that you can get if you just look at low PE or free cash flow per share. I think we failed miserably at creating a similar framework inside the financials. And we had just sort of accepted that most financials have a business model that requires a tremendous amount of leverage. And we stuck with some of the metrics like PE or adjusted per share business value, like book value, maybe adjusting a little bit for assets that weren't stated right, or more importantly for liabilities that were overstated on the balance sheet. But we didn't do a good job of leveling the playing field across banks, for example, for those that had 15% equity to assets versus those that had 5%. And it pushed us to some of the riskier business models inadvertently. And that's something, as we've thought about how we invest in financials going forward, what we could have learned, should have known, and unfortunately had to learn by mistakes. I think we're much more conscious today about trying to have an equivalent model that doesn't make excess leverage make a stock look more attractive. Especially with low interest rates. It's pretty easy to make a stock with lower PE or lower price to cash flow by levering up. And we were seduced by that multiple years ago and didn't fix that problem, unfortunately, until after the crisis. But I think we went into the crisis doing a pretty good job of liability analysis of financials. We thought gap analysis on assets was close enough. Obviously, in hindsight, that was way wrong. I think investors today have switched too far to where they're going down, trying to get almost a false precision level of that values of assets that financials own. But perhaps the bigger misvaluations is on the liability side, where guaranteed annuity contracts at high levels that aren't getting marked to market might need to be marked to market and at significantly higher levels in some cases for some insurance companies, obliterating book value. And the market is always really good at looking at the last problem and learning the wrong lessons too late. And I think what got most of us in trouble was we didn't do enough analysis of assets. So everybody's like, I'll be damned if I'm going to make that mistake again. Now they're really studying assets. Maybe the trap now is the liability is a bigger problem. We're trying to do an even-handed analysis on both sides of the balance sheet and make better adjustments for leverage.
Chidi, I'm not going to do your question because he really mostly answered it. Is that okay? Is Chidi?
Yeah. It's the same. Already.
Right. I mean, I was going to, if you have time, you can act on Microsoft. What I'd like to do for the last question is let you pick, Bill, from the audience. Is there anybody who'd like to raise their hand and ask a question?
We actually got a couple other emails that didn't make the list. So if Fabio Bortolatti wants to ask you, you're gonna ask him.
My question was, all the value investors that we studied here, they always preach for like small portfolios, like focus on 10 or 15 companies. And I saw that your funds, you have like much larger number of companies. So how can you manage to analyze all those companies? Like,
well, first, it's not me analyzing all those companies. I couldn't do that. We've got a pretty good staff of generalist analysts, all of whom are value-oriented and committed to that investment approach prior to joining us. And my job is to edit their selections to the ones that I think are most attractive. And if you look across the portfolios I manage, the most diversified one is the Oakmark Fund, ballpark 50 names, mostly large businesses. We've designed that fund to be the one that if somebody comes to you and says, I want to put assets in a one-stop shopping place for equities, domestic equities, I don't want to think about them for a decade, which one of your funds would be best for that? For us, that would be the Oakmark Fund. We focus on larger businesses because we think that reduces risk, and we have more stocks in that portfolio than we do in most of our portfolios because we don't want a single success or error. We obviously want single successes to have a big impact, but the flip side of that is errors also have a big impact, and we want to diminish that. The Select Fund has about 20 names in it. There, it's because our belief is where we really add value is our stock selection. Most people who use that product have other assets in the equity markets away from Select Fund. This is a sliver of their portfolio. And then the most concentrated one I run is the domestic side of the Oakmark Global Select Fund, where I'm only putting in 10 favorite ideas, and David Terrell, from our international side, is contributing 10 of his ideas as well. And again, there the idea is the investor is taking responsibility for a lot of their diversification, and they're not counting on us to do that. I think the reason you find most of us in the value community saying we want small portfolios is we recognize the skill we bring to the table is stock selection, and we want to maximize the value that can have on portfolios. And I think one of the things our industry has been really slow to adjust to is what a tremendous competitor the index fund is. A lot of us have mocked index funds because then you're letting the market decide how much you want to weight companies. You aren't putting good thought into it. But the index fund is an awfully good competitor for basically no cost. People can get market exposure and get average returns. And I think once you look at the index fund as your main competition, the more diversified your portfolio is, the harder it is to justify earning enough of a fee to run a business off of, and yet still leave the shareholder with a good probability of beating the index fund. And I think value investors tend to get that more. That is the big competition that we face, is passive management, and that we have to justify our existence by doing significantly better over time than a passive fund would do. And you don't want to get so small that one mistake blows you out of the water. I blew up Washington Mutual in our portfolios. It was 15% of the portfolio. Despite that having happened in the last 3 years, my 3-year numbers is better than the S&P and the Select Fund. So that graph that you learned in one of your introductory finance courses that said by the time you get 7 or so stocks in a portfolio, you've actually got a reasonable amount of diversification. That actually works in the real world. You can have 7 or 10 stocks in a portfolio and still recover from a mistake. All of us know we make a lot of mistakes, and you don't want a mistake to be big enough that it can knock you out of the game. On the other hand, you don't want to get so many stocks in your portfolio that your successes don't matter. I sat on a panel at a Morningstar conference once next to a guy who, they asked him how does he structure his portfolios, and he said that he never put more than 0.5% in any single stock position because it was so important to him to make sure his mistakes never mattered in the portfolio. And that was one of the first panels I'd sat on before I realized the custom in the industry is when somebody says something stupid, you aren't supposed to challenge them. So I immediately turned to him and said, but doesn't that mean if your mistakes don't matter, your successes don't matter either? And I got the biggest glare. Okay, maybe I shouldn't have said that. But I think that's something our industry is still coming to grips with. You know, the average actively managed fund still owns 150 stocks. And you're going to diversify across 150 names, charge 1% to manage that, and have your goal be to, over time, beat an index fund that doesn't charge anything. Your probabilities aren't very good. And then we see people go the next step, and advisors construct portfolios of 8 or 10 of these different funds, and then charge a fee on top of that. And then they're surprised that after a decade, their number after fees to their client ends up looking, a lot like the S&P minus 200 basis points. Duh. And you're seeing people move away from that model. They're saying that doesn't work. So now we've got to try alternatives. We've got to go passive. They aren't saying if we're hiring somebody to be an active manager, we want them to be active. We want them to own small stock or a small number of names in portfolios so that if they are actually any good, it really matters and that they can overcome the fee that they charge. One of my pet peeves is we are seeing a movement away from active management of equities toward passive and alternatives that I don't think is in client interests at all. They're maybe moving to 60% passive and 40% 2+20. Instead of giving money to somebody like us that charges less than 100 basis points and will put their assets in 20 names in the Select Fund. And if you lever up Select Fund 150% like the average hedge fund and maybe put a minus 50% weighting in the S&P index, our pre-fee numbers look an awful lot like hedge fund returns do, and after-fee numbers look an awful lot better because we charge a lot less. But the advisor community is having a really hard time seeing that because the way they've diversified across already diversified funds, they're looking at it as a failed strategy.
Yeah, I'm sorry, we don't have time for the last question. Will you read out the names, Sydney?
It was Alex Amron.
Okay. You may. Unfortunately, we're out of time.
Alex. So if you want to ask him privately, I just want you to know you get credit for a good and outstanding question. Bill, thank you very much.
Thank you. Thank you, everybody, and good luck on the job.
Thank you.
Oh, wow. So they said
It's just like, you know, like, it's better like to be like to the job.
Well, not like, well, I mean, you wanted to time it, like, you've been destroyed, you know?
It's kind of
Oh, I don't want. Just wondering.
Eventually, some of them have to I don't think it's right. But yeah, they can put that against someone. You don't know how to be. It was like
It's actually not my little sponsor. Yeah, it's not good.
I'm all in one day. Don't
yeah, it's not like
what you actually want to in many ways, it's just harder. Every little time when the wind on that wing changes, the engine noise changes. What does that mean? Yeah. You go to the hospital. Very hard. Yes, that's right. No, I'm stopping there, and I actually had a new month. We go upstairs at 7:47. It's just a regular coach was upstairs. Go to sleep, you go a little quiet. And they left all the rows in the back section behind the exhibit. Like 6 rows each, and one person. And no one else. And the whole bottom, like I got upstairs, I go, would you ever downstairs? And then you go to the bar, it's all downstairs. Every row packed. For some reason, they left the top open. The only reason I got was because they had calls, we had an exit in the top. And some dude, like, he's sitting down like 2 rows behind me. And then at the bar, he's going to the island right next to us. I'm talking to these chicks. So the guy just starts freaking out. Starts shaking. We're in here. She's taking it for 5-10 minutes. He's like, her. He's a big guy too. Just looking at me. Lost his hand. Girls are freaking out. Over. Starts elbowing the chair. I'm talking to him. Wait. He's just making out with those little things. So he's making out with those. And we're just like losing our minds.
That would be some of hysterical laughter.
I got this guy next to me. Dude, get up here. Look at this. Like, what's going on?
Yeah.
This big guy.
Yeah.
He was huge guy.
If he's just another guy.
He's going to your island. It was a big group of 40 of them.
Oh, yeah.
But they didn't know each other.
Oh my God.
So basically, the story is this. My island is 20 people. I'm the go-to. Midlands called Tabarro's, a very famous service. Some millionaire dude rented out an entire island. I lost paid for 40 people. 33 girls, 9 dudes. So they're all the dudes are like even some like usual things. All the dudes are 40, all the chicks are in their 20s and their 30s. All single. So basically, it was like, hey, you need about girls, you need to think about girls, you need to think about girls, all girls. They all brought on girls from all over the country. Florida, Minneapolis, LA, San Diego, these just a lot of shit shows. We went to the bar, we know only servers go down. The only reason we go down. Maybe that was kind of famous next to change it. So like, no, we just have to stay for it's $4,000 a ton. Like, this guy just dropped $200 on his trip for a week, which is usually for people he's never met. And so anyways, this guy was the lifeguard that he lost. He's like, great.
So you rooting for us?
Yeah.
Blah, blah, blah. Finally, just 30 minutes later, wake up.
You know what?
So the girls went to the air hostess going, I don't know where that was. What? It was Air Pacific. It was like American. They all went like, they were there, turning around, going to water. Yeah. And so that's kind of the only thing I'm telling because we heard it. So it turns out he knew like a bunch of people on the island. I was staying at the Rose. But like, that guy's totally normal. I don't understand what happened. It turned out like one of the guys in the trip like they bought some like drugs in Mexico, like sick or something. Oh, and, like took him and he gave it to him and he like took it to his van. It was his excuse. I think he escaped his meds or something. His excuse was like took that sleeping pills, not even sleeping pills, it was just like a pill, I guess something like that. And then took some Xanax and took like an Ambien or something like that, and just pulled it out of the system. And I was like, I don't know, I'm not taking Xanax.
Oh, the next week, folks. It's the X Factor. I don't know.
Definitely the X Factor. He was perfect.
Yeah.
And he's like, usually that shit just makes you tired and just groggy and like on your own world. But he was like,
He's a real extrovert.
he was really like, not kidding, making out, like just calling out, like licking.
That's very important.
Fucking
Pettiness is one of the dirtiest things in existence.
I don't know how this plane makes money. They do one flight a week.
It's it.
What they only make you 2 flights back and forth, but
Any bought the entire time, do they set?
They just hold parties inside. Like, we're just at the gate.
yeah, I don't know. It's a 747, but they do one flight a week, one round trip flight.
They
Saturday.
said it, 7%. They got
They said they do. Maybe they use it for something else, but I don't think so.
maybe like 5 once to the US, maybe like once.
Maybe they fly once to Australia or something like that. Maybe, but it's such a short flight to Australia, it's 3 hours. They don't use
They do that shit at 8.
No, I mean,
They do like a lot of short haul, 7%.
I can't fly like 1 hour, so for something like 6 a day or something.
Yeah, it's crazy.
Because they have the people farm, I guess?
Yeah.
Maybe. I don't know who else comes into Fiji. Oh, most Australians. Where? When did they go to Australia? Air Pacific? You ever Air Pacific in Australia? Yeah. All the Australians are on a plane. But I think they don't fly in Australia. Yeah, they only do a Saturday. They do a Saturday. Saturday. Exactly. No, but I'm sure it would be the old. 747.
Just totally depreciated.
That's the only thing gives me comfort. There's only like 1 or 2 747s in crash around ever. And one was hijacked.
Yeah.
And the other one was Japan, I think.
Yeah.
Jeez. The other one was that big, that Ethiopia Airlines that got hijacked. They had no water. Have you seen that footage of that?
Oh my god.
They tried to
think so.
hijack it, and the tank, the wing hit. It just blew. It looked like a fucking race car. You know, just blow apart into like 1,000 pieces.
With fucking
But the plane except with that 400 people. Oh my god. He was gnarly. He's almost had it too, you know. And then like the hijacker, they said, bombed him or something.
Really?
Yeah, I forget what it was.
No, I'm not sure. The fuck being a passenger on the plane, you're like, maybe, no. That fucking sucks.
They don't take I think they're trying to go to Australia. You know where this?
No, what is this?
So they ran out of fuel and they ditched.
I think that's what they ended up having to come down. It's a circle for a long time saying, let's go to Australia. Listen to Australia. Maybe it was Somalia. They're trying to go to Somalia.
That makes sense.
For some reason, they want to go to Australia. I swear. There are some. There's a couple guys.
Yeah.
One of the guys they just caught in the U.S., they shipped him back to Australia, right? One guy was white kid in Australia.
Yeah, wow.
Yeah, it was just.
It's just that it's a GK we wanted to like fire with it. It's like went to the training camps and shot buses.
He's in jail for the rest of his life or something, right?
No,
Maybe he's out in Australia.
You can find other ways to shoot guns, man.
Go to Cambodia.
we had guns in Australia.
Okay.
So we're gonna get it.
Okay, all over shoot water buffalo. Yeah. Yeah, so it was interesting, like, cool. Guys are doing mental. I'm sitting at the exit row, so I'm like, goddamn, am I gonna fucking defend this guy? But I guess it's a pretty hard to hold things over the hawk out at 35,000 feet.
Yeah,
It's like really open doors. Because they open inside. I've always wondered that from about 3 years ago. I finally figured it out that they open the thing. It's like, can't someone just go fly out?
I think all kinds of alarms go off. You open it in like, if you got
Or like the safety lever before
yeah,
you can actually
open the safety.
Yeah, they alarm the doors, what they call it.
They can't. You must be able to open the doors.
No,
It's like pressure out of it, right? So
I think it's about when you like maybe like 5,000 feet, maybe even at slow, like whatever. I know it's been done in like when they're taking off.
yeah.
Oh,
Okay. Yeah.
Like people try to do it by taking off. I think you can actually get the door. You can unlock it. Actually, so yeah, some guy did it in LA.
Really?
Yeah, it was long ago.
Who's trying to accomplish?
He was some like he got a Johnny Dax over that freaked out.
watch Guitar Strike Friday. And then some guitarist or some band. You remember this? Some guitarist or some like rap rock group, Linkin Park. It was something like they weren't as famous as Linkin Park, but it was something like that. What the kids are listening to these days. Tackle. Yes. Yeah. Fiji is a place. So pretty boring if you didn't surf. Or if you don't have 12-1 girl generation. Or no girls at all. We had 20 dudes on that. Not a single girl. Wow. You start freaking out. There's no city. The island is literally this floor and that other room. It's a dot of sand. It's a dot of sand. Have you seen that? Have you read that? Did you ever read page 2 on ESPN? Have you heard of Bill Simmons, the sports guy? Everybody sent me an email. It's like, he's talking about the different levels of broke, like how broke you can get in life. It's like number 18, college broke. It's like you go out, $15 in your wallet, you somehow drink 15 beers, have 3 slices of pizza, 14 shots, and you wake up with $12. He goes, being in college is like being in an episode of Lost. You're stuck in a little place with a bunch of people that you have to be civil with people you don't really like that much. And he's like, and then you get away from it, and all you want to do is go back. It's like they got off at it, and all they want to go back. So there are 20 levels of broke? I think it was like 30 levels of broke. Wow. I think he's got it. He just typed that. He's pretty fun with that. I guess one way, his buddy are doing like some take-home final right now in the library. I wonder if the library was printed out, is it?
Yeah, it's fine.
Final. Really? Final?
I don't know. It's like sad change. Are you gonna do it?
What's that sad? Final, this is
not. See, the problem is I don't have a printer now, so when it's my ability to change it.
Oh, yeah. Wow.
We also have we have like a tube TV and no cable also, so it's kind of like living that.
You'd be proud, buddy. I just ordered canceled cable today.
Yeah.
Wow. New cable at the new apartment. Only internet. No cable. No cable. Pretty wild for me. Pretty wild. Because I was just thinking, I was like, fucking, you're away from TV. Like, you don't need it at all. You know, really, you don't need it. You're like, but then when you have it, you're like, I really need to watch Lost. Love that show. But then you don't. When you're away from it, you're like, oh, you realize it's not that important in life.
Watch movies,
Yeah, we need to pick up that paper clip. DVR. We don't need it.
I think I saw picked up paper clip. Not paper clip. I picked up the. Well, when I get attention.
I gotta go look at it. Okay, flip that one.
Do you guys have? Yeah. Do you want to turn my paper clip or something of yours?
Wait, so you're saying this is in the next thing off anyone from my folder? You said you dropped off my paper clip.
Oh, your actual paper clip? No, your actual paper clip will look something like this.
Paper clip?
Yeah. I put it at the bottom. Okay.
Candy cane paper clip?
Yeah. I don't know. I thought it would go pretty quick. Come on, these guys. This is not as offensive as I thought. I thought somebody would just reply like the joke. Yeah. I did very last I was really bored.
I told them I wanted to do it.
I don't know what I've done that.
I told them there was weather and my flight got canceled. I suppose there was weather here this weekend.
There was a Good thing number 5 about having a baby. You gotta be bumped. And you get upgraded. Really? That's good. Good thing number 1. Yeah. I'm not sure the first one.
Still figuring out the first one. My buddy every time I email him, I'll go like, baby, he's like a business guy. He always wants low ROI. Low ROI. investment, not a lot of return.
You're way out. You're like 30 years out.
30 years out. You getting all psyched for your move, dude?
Pumped up, man. Doing something every day.
What else? Yeah, you like fucking buy a house and buy
Cars.
cars.
I mean, like, we're going to decide where we want to live. We want to do like a company provided place. We want to get one on our own. So we reverse this. We want to, be kind of hard we want.
You know anybody nearby?
A couple actually. There's actually a kid from London who graduated with 8, and then one of my buddies is also in the same class as him. And like I happened to meet a couple years ago, and we were just going out together. And he's like, "Oh, I live in Düsseldorf." I was like, "Sounds like a cool city." 2 years later, don't think I'll go there. Man, come to Düsseldorf. All right, sweet. So, yeah, it's pretty honestly hot.
I'm sweating right now.
This is up to par.
Whoa. We got a fan over there too. We got two fans
This
actually.
is up to par. This, I like the lighting in this room.
I like the lighting in this room. This is a classroom. This is a classroom. Please tell me it's touch. No touch?
Sure, don't mess with that, man. We get kicked out.
This is a classroom.
There are cameras all over here.
They have cameras all over here, but I'm not doing anything.
You're touching the freaking computer.
This is obviously public. I mean, if they have it all open like this. They have shit in here. They need to get that together. This is a classroom. This is a place where you can teach.
Fucking hiding, man.
They need janitors, though.
Janitors. Can't believe you just said that.
Look at that. Look, they have trash all over the tables, man. This is Columbia University. Jeez.
Man, look at the level of these classes, man. It's 60,000 or some shit. These are introduction classes, too.
Nothing's hard if you want it. No class is hard.
How much time do you have to put in?
Oh my gosh.
What?
Mark Lamont Hill teaches here.
Who?
Mark Lamont Hill.
Who's that?
Let me pay my respects to Columbia University.
Yeah, let's get that out of here.
Ah, Mark Lamont Hill.
I don't even know who that is.
You know who Mark Lamont Hill is?
Never heard of him.
Oh man, let me see if I can connect to their server.
They give me your password.
Jeez.
Who is that?
Oh my gosh, who is that? What are you living in the Stone Age, man? Yeah, like saying that. Mark Lamont Hill was probably in here teaching a class. No, he doesn't teach. He teaches now you might be. Damn it! Why didn't I think of that? What the hell? I should
Look
say
at this. Look at this.
I had a chance to meet Mark Lamont Hill and I blew it.
Why?
Because I could have just came to one of his classes.
You can come in tomorrow.
Maybe I could come in the morning.
Yeah. They have like, you can sign up online or something, or join a tour.
Just want to see Mark Lamont.
Yo, your hair's going back, by the way. It's going away.
You don't know. It's like. I probably want to go to the table to say,
This is for real. Look at this shit, man. He's back as well. He's back as well. So
you have to learn it, man. They probably don't even use it, man.
you're probably from.
I'm telling you, I don't think this college is much harder than it at all. I don't even think it's harder. I promise. That's how I feel. You think this college is harder than Hamilton?
I don't know, man. I haven't been to their classes.
Not for a second, man. Hamilton will give you fucking run for your money. And I don't think it's possible for anyone to work harder than I've worked in some stuff. I think anyone can work as hard or slightly harder. I used to go to bed at 3 o'clock every single night and wake up at 7. Like, there's not more time in the day. Like, with these students here step to 5, I don't know. It's impossible.
Can't be hard. Get out of here.
Mark Lamont Hill.
I don't know who he is, really.
What the hell? What is wrong with you? Pay your respects.
I don't even know who he is.
He teaches here, man. You need to pay your respects, man.